Welcome to today's lecture. Good morning, everyone. I hope you're all ready and excited for today's lecture. We are going to delve into Chapter 7 of our financial reporting course, which is all about presentation and disclosure. This chapter is crucial as it forms the foundation for how financial information is communicated to users, ensuring clarity, relevance, and comparability. Content overview. In Chapter 7, we will cover the following key topics: presentation and disclosure as communication tools, presentation and disclosure objectives and principles, classification, classification of assets and liabilities, offsetting, classification of equity, classification of income and expenses, profit or loss and other comprehensive income, aggregation. Each of these sections is vital for understanding how financial information is organized and presented, enhancing the overall utility of financial statements. Introduction to Chapter 7. Let's dive into the essence of Chapter 7. Presentation and disclosure are essential tools for communicating a reporting entity's financial information. Effective communication ensures that this information is not only relevant, but also faithfully represents the entity's financial position and performance. This involves focusing on presentation and disclosure objectives and principles, rather than adhering strictly to rules. It also means classifying and aggregating information in a way that enhances understandability and comparability without obscuring details. For example, when presenting financial statements, it's important to group similar items together and separate dissimilar items. This helps in providing a clear and accurate picture of the entity's financial health. Moreover, effective communication in financial statements is supported by principles that prioritize entity-specific information over standard descriptions and avoid unnecessary duplication. In this chapter, we will explore how to effectively present and disclose financial information, the importance of classification, and the principles behind aggregation. We will also look into the specific requirements for presenting profit or loss and other comprehensive income. We will cover each title in detail with examples to make these concepts understandable for everyone. By the end of this chapter, you should have a solid understanding of how to present and disclose financial information in a way that is both clear and useful. Let's get started. Presentation and disclosure as communication tools. Introduction. Presentation and disclosure in financial reporting are not merely about showing numbers. They serve as powerful communication tools that convey the financial health, performance, and position of a reporting entity. The primary goal is to make financial information understandable, relevant, and comparable for users, which include investors, creditors, analysts, and other stakeholders. Key concepts. 1. Communication of financial information. Financial statements communicate information about an entity's assets, liabilities, equity, income, and expenses. Effective communication makes the information more relevant and faithfully represents the entity's financial status. It enhances the understandability and comparability of the financial data presented. 2. Effective communication requirements. Focus on presentation and disclosure objectives and principles rather than strict rules. Classify information in a way that groups similar items and separates dissimilar items. Aggregate information such that it is not obscured by unnecessary detail or excessive aggregation. Detailed explanation. Effective communication of financial information. The presentation and disclosure of financial information in statements are essential for making the data comprehensible to users. When financial information is communicated effectively, it becomes more relevant, thereby aiding users in making informed decisions. It also contributes to a faithful representation of the entity's financial reality. Effective communication requires objectives and principles. Instead of following rigid rules, focusing on the objectives and principles of presenting and disclosing information is more beneficial. This approach ensures that the information provided is meaningful and useful to the users. Classification. This involves sorting financial data based on shared characteristics, such as the nature of items, their function within business activities, or measurement methods. Proper classification helps in grouping similar items and separating dissimilar ones to avoid confusion. Aggregation. It is about summarizing financial data to prevent it from being lost in excessive detail or overly aggregated. Finding the right balance ensures that important information is neither hidden nor overly simplified. Examples. Presentation objectives. If a company focuses on presenting its financial information based on objectives, it will provide insights into its financial performance and position in a way that is tailored to the needs of its users. For instance, a tech company might emphasize revenue from software subscriptions separately from hardware sales to give a clearer picture of its income streams. Classification of assets and liabilities. An entity might classify its assets into current and non-current categories. Current assets, like cash and inventory, are expected to be converted to cash within a year. Non-current assets, such as property and equipment, provide long-term benefits. Similarly, liabilities can be classified into current, payable within a year, and non-current, payable after a year. Aggregation of financial data. Aggregating sales data for various regions into a single line item called total sales in the financial statement simplifies the presentation. However, additional notes may provide a breakdown to maintain transparency. For example, total sales might be broken down into North America sales, Europe sales, and Asia sales in the notes section. Constraints and considerations. While effective communication is the goal, there are constraints, such as costs. The benefits provided to users by presenting or disclosing particular information should justify the costs of providing and using that information. Hence, decisions about presentation and disclosure need to balance usefulness and cost-effectiveness. Cost constraints. For example, a small business may find it too costly to disclose detailed segment information that a larger corporation might routinely provide. The cost-benefit analysis helps decide the level of detail that is practical and necessary. Conclusion. In summary, presentation and disclosure as communication tools in financial reporting aim to make financial information relevant, understandable, and comparable. This is achieved by focusing on objectives and principles, classifying similar items together while separating dissimilar items, and aggregating information appropriately. These practices ensure that users can easily interpret the financial data, leading to better decision-making. In the following sections, we will explore these concepts in greater detail, supported by examples to enhance understanding. Presentation and disclosure objectives and principles. Introduction. Presentation and disclosure in financial reporting must balance flexibility and comparability. By understanding the objectives and principles behind these practices, we can ensure that financial statements communicate useful and relevant information effectively. Detailed explanation. Objectives of presentation and disclosure. 1. Flexibility to provide relevant information. Entities need the flexibility to present information that faithfully represents their specific circumstances. This means allowing room for entity-specific information rather than adhering strictly to a standardized format. Example: a startup tech company might highlight its research and development expenses separately to show its commitment to innovation. This flexibility helps stakeholders understand the company's strategic focus and potential for future growth. 2. Requirement for comparability. Financial statements must be comparable across different periods and entities. This comparability allows users to track an entity's performance over time and to compare it with other entities. Example: a manufacturing company must present its financial statements in a way that is consistent with previous periods. If it reports revenue from different product lines, it should continue doing so each year. This consistency enables investors to compare the company's performance year over year. Principles of effective communication in financial statements. 1. Entity-specific information over boilerplate. Entity-specific information is more useful than standardized descriptions. Boilerplate text. Tailored information provides a clearer and more accurate picture of the entity's unique financial situation. Example, instead of using generic phrases like revenue increased due to market conditions, a retail company could specify revenue increased by 15% due to the successful launch of our new online platform and increased customer traffic during the holiday season. This specificity provides clearer insights into the reasons behind financial changes. 2. Avoidance of unnecessary duplication. Duplication of information in different parts of the financial statements should be avoided. Redundant information can make financial statements harder to understand and may overwhelm users. Example, if a company's balance sheet includes a detailed breakdown of its liabilities, there is no need to repeat the same breakdown in the notes section. Instead, the notes could provide additional context or explanations that complement the main financial statements. Key objectives and principles in detail. Balance between flexibility and comparability. Flexibility allows entities to provide information that is most relevant and faithfully represents their unique circumstances. Comparability ensures that users can compare the financial information of different entities and across different periods effectively. Example, a global corporation operating in multiple sectors might need to provide detailed segment reporting to reflect the diverse nature of its business. This flexibility helps stakeholders understand the performance of each segment. At the same time, the corporation must ensure that its segment reporting is consistent from year to year to maintain comparability. Effective communication principles. 1. Entity-specific information. Financial statements should prioritize entity-specific information over boilerplate language to increase usefulness. Example, a healthcare company might include detailed descriptions of its investment in new medical technologies. Rather than saying, "We invest in technology," it could specify, "We invested $5 million in AI-driven diagnostic tools, which reduced patient wait times by 20%. 2. Avoidance of duplication. Redundant information can clutter financial statements. Avoiding duplication helps maintain clarity and understandability. Example, if an annual report contains a comprehensive overview of a company's sustainability initiatives, there's no need to replicate this information in multiple sections. A single, detailed section on sustainability is more effective and easier for users to digest. Classification and aggregation. Classification involves sorting assets, liabilities, equity, income, and expenses based on shared characteristics. Aggregation is the process of summarizing information to avoid unnecessary detail while still conveying the essential financial data. Example, a real estate company might classify its properties into residential and commercial. Within these classifications, it could aggregate rental income from all residential properties into a single line item in the income statement. Further details, such as income from individual properties, can be provided in the notes if necessary. Conclusion. Understanding the objectives and principles of presentation and disclosure is crucial for preparing effective financial statements. Flexibility and comparability must be balanced to ensure the information is relevant and consistent. Entity-specific information enhances usefulness, while avoiding duplication maintains clarity. Proper classification and aggregation of financial data further aid in effective communication. By adhering to these principles, financial statements can provide a clear, accurate, and comprehensive view of an entity's financial position and performance. Classification Introduction. Classification in financial reporting involves organizing financial data based on shared characteristics. This helps in presenting and disclosing information in a way that enhances understandability, relevance, and comparability. Proper classification ensures that similar items are grouped together and dissimilar items are kept separate, providing a clear and accurate picture of an entity's financial situation. Detailed explanation. Classification of assets and liabilities. Definition. Classification is the sorting of assets and liabilities based on their characteristics, such as nature, role within the business, and measurement methods. Example, current versus non-current assets. Current assets are expected to be converted into cash within a year, e.g., cash, accounts receivable, inventory. Non-current assets provide long-term benefits and are not expected to be converted into cash within a year, e.g., property, plant, equipment. Current versus non-current liabilities. Current liabilities are obligations the entity expects to settle within a year, e.g., accounts payable, short-term loans. Non-current liabilities are obligations that are not expected to be settled within a year, e.g., long-term debt, deferred tax liabilities. Practical example. A retail company classifies its inventory, current asset, separately from its store buildings, non-current asset. Similarly, it classifies its short-term supplier credits, current liabilities, separately from long-term bank loans, non-current liabilities. Offsetting definition. Offsetting occurs when an entity recognizes and measures both an asset and a liability separately, but groups them into a single net amount in the financial statements. This is generally not appropriate as it obscures the individual characteristics of the items. Example: not offsetting. An entity has an accounts receivable of $50,000 and an accounts payable of $20,000. Instead of reporting a net amount of $30,000, the entity should present both amounts separately to provide a clear view of its receivables and payables. Practical example. A manufacturing company has a bank loan of $100,000 and a bank deposit of $30,000. Instead of reporting a net liability of $70,000, the company should report the loan and the deposit separately in the financial statements. Classification of equity. Definition. Equity classification involves organizing equity claims based on their characteristics, such as legal, regulatory, or other requirements. Example: types of equity. Common stock represents ownership and voting rights. Preferred stock typically does not confer voting rights, but has a higher claim on assets and earnings than common stock. Retained earnings, cumulative earnings not distributed to shareholders and reinvested in the business. Practical example, a tech company may have common stock, preferred stock, and retained earnings. It should present these components separately in its equity section. For instance, it could show $1,000 in common stock, $500,000 in preferred stock, and $200,000 in retained earnings. Classification of income and expenses. Definition. Income and expenses are classified based on their nature or function within the business. This helps in providing a detailed view of the entity's performance. Example: income, operating income, earnings from primary business activities, e.g. sales revenue. Non-operating income, earnings from secondary activities, e.g. interest income, gains from asset sales. Expenses, operating expenses, costs incurred in primary business activities, e.g. cost of goods sold, salaries. Non-operating expenses, costs incurred in secondary activities, e.g. interest expense, losses from asset sales. Practical example. A restaurant chain may classify its revenue from food sales as operating income and revenue from renting out event space as non-operating income. Similarly, it classifies food costs and staff wages as operating expenses, while interest on loans is classified as a non-operating expense. Profit or loss and other comprehensive income. Definition. Income and expenses are included either in the statement of profit or loss or in other comprehensive income, OCI. The statement of profit or loss is the primary source of information about an entity's financial performance for the reporting period. Example: profit or loss includes all income and expenses that determine the net income or net loss for the period, e.g., sales revenue, cost of goods sold, administrative expenses. Other comprehensive income, OCI, includes items that are not included in profit or loss but affect equity, e.g., unrealized gains and losses on certain investments, foreign currency translation adjustments. Practical example. A multinational corporation may report its sales revenue, cost of goods sold, and operating expenses in the profit or loss section. At the same time, it may include foreign currency translation gains and unrealized gains on available-for-sale securities in the OCI section. Conclusion. Proper classification of financial data into assets, liabilities, equity, income, and expenses is essential for clear and accurate financial reporting. Each category has its characteristics and requires careful consideration to ensure that financial statements provide useful, relevant, and comparable information. By following these principles, entities can communicate their financial position and performance effectively, aiding stakeholders in making informed decisions. Aggregation. Introduction. Aggregation in financial reporting involves summing up individual items that share common characteristics to present a more concise and comprehensible summary. While aggregation helps simplify financial statements by reducing unnecessary detail, it's crucial to balance this with providing enough information to ensure that users can make informed decisions without obscuring important details. Detailed explanation. Purpose and importance of aggregation. Definition. Aggregation is the process of adding together assets, liabilities, equity, income, or expenses that have shared characteristics. This method helps present a clearer and more concise view of an entity's financial position and performance. Example. A company might aggregate all expenses related to marketing into a single line item called marketing expenses, rather than listing each individual expense separately. This helps users quickly understand the total marketing costs without sifting through numerous entries. Practical example. In a retail company's financial statements, the cost of goods sold, COGS, is an aggregated figure that includes the cost of raw materials, labor, and overheads. Instead of detailing each cost separately, COGS provides a single, understandable figure representing the total cost of producing goods sold during the period. Levels of aggregation. Different levels for different parts of financial statements. Aggregation levels can vary depending on the part of the financial statements being presented. Generally, the primary financial statements, balance sheet, income statement, cash flow statement, provide summarized information, while notes and supplementary schedules offer more detailed breakdowns. Example, balance sheet. Aggregates assets into categories like current assets and non-current assets. Aggregates liabilities into current liabilities and non-current liabilities. Income statement. Aggregates revenues and expenses into categories like operating revenue, operating expenses, non-operating income, and non-operating expenses. Practical example. A manufacturing company's balance sheet might show property, plant, and equipment as a single line item, aggregating all its physical assets. In the notes, it provides a detailed breakdown of this figure into land, buildings, machinery, and equipment. Balancing detail and summary. Finding the right balance. Effective aggregation involves striking a balance between summarizing information and providing enough detail to avoid obscuring significant data. Over-aggregation can lead to loss of important information, while under-aggregation can overwhelm users with too much detail. Example, over-aggregation. Reporting a single figure for general expenses without breaking it down can obscure significant expenses like legal fees, research costs, or travel expenses, which might be relevant for users to know. Under-aggregation. Listing every minor office supply purchase separately in the financial statements would clutter the report, making it difficult for users to see the bigger picture. Practical example. A tech company might report research and development expenses as an aggregated figure in its income statement. However, in the notes, it can provide a breakdown showing how much was spent on different projects, salaries, and equipment. This approach maintains clarity while ensuring that users have access to detailed information if they need it. Conclusion. Aggregation is a critical practice in financial reporting that helps present a clear and concise summary of an entity's financial data. By aggregating items with shared characteristics, financial statements become more understandable and easier to analyze. However, it is essential to find the right balance between providing a high-level summary and offering enough detail to ensure that no significant information is obscured. Through careful aggregation, entities can effectively communicate their financial position and performance, aiding stakeholders in making well-informed decisions. Summary of Chapter 7, Presentation and Disclosure. Welcome to today's lecture. In Chapter 7, we explored the crucial aspects of presentation and disclosure in financial reporting. This chapter provides a comprehensive understanding of how to effectively communicate financial information to users through financial statements. Key topics covered. 1. Presentation and disclosure as communication tools. Financial statements communicate information about an entity's assets, liabilities, equity, income, and expenses. Effective communication enhances the relevance, understandability, and comparability of financial information. 2. Presentation and disclosure objectives and principles. Balancing flexibility and comparability ensures that financial statements provide useful, faithful representations of an entity's financial position. Emphasis on entity-specific information over boilerplate text and avoiding unnecessary duplication enhances the clarity and usefulness of financial statements. 3. Classification. Proper classification of assets, liabilities, equity, income, and expenses helps in organizing financial information based on shared characteristics. Offsetting, classification of equity, and income and expenses were discussed to ensure that financial data is presented in a clear and distinct manner. 4. Aggregation. Aggregation involves summarizing items with shared characteristics to present a concise and understandable view of financial data. Finding the right balance between summarizing and providing detailed information ensures that important data is not obscured while maintaining clarity. Conclusion. By understanding the principles and objectives of presentation and disclosure and the methods of classification and aggregation, we can prepare financial statements that effectively communicate an entity's financial situation. This chapter equips us with the knowledge to present financial information in a way that is both useful and comprehensible to stakeholders. Thank you. Thank you for your attention and participation in today's lecture. We will see you in the next and final chapter, Chapter 8, where we will conclude our exploration of the conceptual framework for financial reporting. See you next time.